Buddy, let's get everyone in the room. Okay, Shane, you're the co-host. Let's submit everyone. Okay, let's rock and roll. Day 2. How did you find day 2? So it's day 2 of the Q&A. And again, I'm not providing you financial advice, but I will share with you what I've learned and what my mistakes were. So as always, you get to control how this operation works. Okay, Kelly, I'll also make you co-host. If you guys could just let people in if they're coming, please, I'd appreciate that. So what we're going to do with the session, as always, is that you basically run the session. Now, I've got some interesting questions for you. One of the things that we have with our Friday sessions is people actually really enjoy having breakaways and being able to talk kind of one-to-one in terms of with other people. So my question to you is, would you like me to kind of go through stuff, answer questions for about the first kind of 30 minutes, and then we can maybe break away into groups, little groups, maybe one or just two people in a group, and you can actually just chat and like say, what would be some of the takeaways, get to know other people. I find there's incredible value in me not talking, actually you talking, engaging your brain, talking to others, or, you know, just engaging, meeting other like-minded investors. So would you like to do that? Just type in the chat box if you'd like to do that. It's always interesting. So Bram says, yes, please. Okay. I just think there's a huge amount of value in that in terms of running this process. Just by the way, I've got new screens and cameras now, and I'm trying to figure this stuff all out, trying to figure out where I'm supposed to be looking. It's going to take a bit of getting used to flying this new airplane in terms of this. So Nirvana's saying, yes, please. What about everyone else? Come on, there's 13 of you. I'd love to know your feelings in terms of whether you'd like to do that. So let's get started with, I want to go through what I said today, which is structured notes, and then some of the investment terminology, which is really, really important that I think you need to know. And but before I go there, are there any questions around today? Like there's a hell of a lot of detail we carried today to put in perspective. Like when we're doing Wealth Going Global, I actually take 4 weeks. So 4 weeks to do what I tried to do this morning in 2 hours. Okay, and that includes with Gary Sachs and all the information and value that he brings. So, you know, it's a lot of stuff, and there's no ways, and I don't even try and kid myself. There's no ways that I'm going to be able to do it all within the time, and you know, but I also want to make sure that I'm giving everyone a high level overview so that you've got a good understanding of what you need to know when with regards to what we're doing and how to invest like the top 1%. And I hopefully, you know, one of the reasons I love the interview with Gary Sachs is that he gives such good insight into like what a top 1% investor thinks like. I mean, Connie, I know you replied and said, like, I think you said I'm in or something, like, because when you truly understand it, you're like, well, hang on, I could go out there and I could run around, I could go on a property course, I could run around, I could read a book like, where's it gone now? Real Estate Riches. And this book says, you know, go look at 100 houses, make an offer on 10, get accepted for 3, buy 1. And then I can go and buy all those properties and I can manage them and I can maintain them and, you know, deal with broken toilets and roofs and all that stuff. And anyone who's ever bought houses knows what I'm talking about because it's a bloody nightmare in terms of hassle. I could do all of that, or I could just invest alongside Gary. End of the conversation. Like, do you understand? No management, no broken toilets, no maintenance. I mean, I can show you pictures if you're interested because I went to the building in February. I was blown away. I was literally blown away by the caliber of the building, the concierge, the coffee shops, the gyms. I mean, they've got 750 units there. Gary owns about 440 of them himself. And that's what we're wanting to partner with him in. He's got, you know, all his own management taken care of. You know, he's got all the bank financing. You know, the banks of Allied Irish Bank and Investec provide all the funding. They've got a full management team, maintenance team. Like, it's kind of a no-brainer. Well, in my opinion, it's a no-brainer. Like, if we are traditionally doing it mom and pop style, we're going to pay, if you invest in London, anyone who's invested in London knows what I'm talking about, you're going to be paying somewhere between 15 to 20% in costs. So that's for management, maintenance, like that sort of stuff. If you take rates and taxes, it's probably quite a lot more. But I'm just talking in management fees, you're looking at around 20%. Whereas Gary's doing it for less than 10%. So like he's already, he spoke about economies of scale. Because you've got 750 apartments in one building, or it's actually 4 towers, but it's in one area. Then everyone is located on site. They're all full-time employees. And so the cost becomes a hell of a lot more affordable. And it becomes a kind of a no-brainer. Does that make sense? Okay. So Kevin, the question I asked was, would you like to do breakaway rooms just now, once we've been through the stuff, so that you can actually understand this and just chat with others? So I see not many people have responded, so I'd love to know everyone else's thoughts. But anyway, let's go into structured notes. So I want to get my screen up here.
Can I ask a quick question?
Please fire. Go for it. Anytime you want to ask a question, you can.
Yeah, hi Scott. I was wondering, when you invest in a different country, obviously the aim is to invest in different currencies. But on the Wealth Migrate platform, if you invest in Germany or in the UK or in the US, it's all you invest in US dollars. So you're diversified but not diversified.
So just remember, so we use our Lemonway wallet. So Lemonway is our digital wallet provider out of Europe. They actually do have multiple wallets, just so that you know. So they've got pounds, they've got euros, they've got dollars. We cover the costs for investors. So we pay about 4,000 euros a month, so that you guys don't have to pay transactional fees on the banking. Every time you have a different currency wallet, we would have to pay another 4,000 euros. Okay, so we've just chosen at the moment to use the US dollar wallet. However, saying that, when you invest alongside Gary, you're investing in England, you're investing in an English building, and you're investing in pounds. So there's a conversion right up front into pounds. The asset is held in pounds, and the income is paid in pounds, and the capital growth is in pounds. And it just gets converted back into dollars, back into your wallet. So you're not losing, because if the dollar goes up or down, or sorry, the pound goes up or down, you're benefiting. If the euro goes up or down, you're benefiting. So it's basically just a day trade when the transaction happens. But the asset that you're holding is in pounds if it's in England, and if it's in Germany, it's in euros.
Okay, perfect. Thank you.
Okay, that's a great question though, in terms of that process. Okay, so I want to. Is that cool, Connie? Did that help? You had a question yesterday as well. Did we answer it for you? Or apparently, when I saw the chat box afterwards, I realized that I'd missed your.
That was the same question. It was the same question.
Okay, cool.
Yeah.
Okay, good.
Thanks.
Excellent. Okay, so let's go here and let's go share. Okay, so what are you seeing now? Cool. Okay, so what I want you to do now is I want to go down here. So if you look here, we are now looking, you should be able to just confirm, all of you, you're seeing institutional, wholesale, retail, huh? Yeah. Okay. So the first time Chad Pope comes along to me and he says to me, "Hey, Scott, there's this other game that's going on, and most of us don't really are not even being invited to the party." And I was like, "Well, that doesn't sound really fair." So you and I go along to a bank and we give our money to a bank, and we kind of get retail returns of about 4 to 8%. Would you agree? I mean, depending on where you are in the world, actually might be a little bit less, but the point being is the retail investor is getting about 4 to 8%. Then if you go to the next level, there's a level of banking where you deposit money and you're getting a wholesale rate of about 8 to 10%. And then finally, there's what's called an institutional rate, and that's where you're getting kind of 10 to 15%. Now, I'd never heard about this. I told you earlier, up until 2019, I'd never heard of this. And then I asked Chad, well, what's the minimum investment? He said, well, £2 million. So you have to deposit £2 million in one structured note. Now, that's quite a lot of money to risk, basically, in simple terms. And so, not many people have £2 million lying around to invest once off. And so that's why most of us have never even heard about it. And again, no financial planner bothers to even tell us about it because it just wasn't accessible. 6 years ago, it was not accessible. 7 years ago, 2019, what is that? 6 years ago. Whereas now, with technology, Chad came to me and he said, well, hang on, Scott, just in the same way you took a $16 million building and you cut it up into pieces, it's called fractionalization, so that others could participate in it, why could we not do the same thing with structured notes? And I said, well, we could. And our platform can literally facilitate that. And that's actually where Cashbox was born, because effectively they took $2 million offerings and they allowed all of us to participate at this level in terms of structured notes and now be able to participate. And on Cashbox, their minimum investment is $10,000. On Wealth Migrate, it still remains $10. So our whole philosophy is, how do we always democratize access, but to this institutional level? And in simple terms, all that the banks do is they take your money and they invest it in kind of, I'm going to call it fancy ways, because they actually make more return on your money than 10 to 15%. It shows you how much money they're making off the retail investors. Why do you think the banks have the biggest buildings and are like the most profitable institutions on the stock market generally? Because they're taking everyone's deposits and they literally are making all this money off them. And so this for me, the first time I learned about this, I got quite angry, because it was like there's a whole party going on that we weren't invited to, that we are now invited to, that effectively is what's called structured notes. And the last thing I'd say with structured notes that I find very interesting is that Nirvana, I think, is online. And in recent years, maybe in the last year or two, I've noticed a bunch of the banks are coming out and now starting to offer structured notes to, let's call it the more middle class, or maybe at least it might be the private banking clients, etc. They definitely are offering it more and more now, because using technology, they've realized how to democratize it. But one of the things I think you've got to be very careful of is that not all structured notes are the same. And it's quite a deep science in terms of understanding how it works. And again, if you want to know everything that I'm sharing with you here, I need to stop sharing. Hang on. I'm not an expert in structured notes, and I don't intend to try and be one. What I think I'm very good at, though, is going and finding partners that are good at what they do. So if you want to learn about structured notes, you can literally go here to structured notes, and Chad will take people through. It's an hour and 40 minutes where he'll take you through what are structured notes, how do you learn about them, how do you manage risk, etc., etc., etc. My strong recommendation, though, is that you need to have partners that you trust when you do structured notes. Like Nirvana and I were talking just this morning on WhatsApp, and she was like, can you evaluate these two structured notes? And I was like, no, I can't. Like, I'm not an expert in structured notes. I know a little bit to be dangerous, but there's no ways I can look at one structured note over another. So we only work with two structured note partners. We work with the company that comes as part of our family office, the Calio team, and we work with Cashbox. They're the only two that we work with because I trust both of them, and I know that they know how to analyze structured notes. I don't know how to analyze structured notes, and I'm not going to try and sit and be an expert on everything. In fact, it's impossible to be an expert on everything. What was interesting is there was a structured note offered by Investec Bank in January or February this year, and we happened to have a live session in February with Andrew and Chad from Cashbox, and they went through that structured note and they showed us and the clients and basically the mastermind members how that product was just layered with fees all the way through. So it's very easy to layer something with fees if you don't know what you're doing, or sorry, if the investors don't know what they're doing. And so it's something to be aware of. Like, again, not all structured notes are the same. And I think that's quite important in terms of that process. Okay, does that make sense? Is that enough for you on structured notes? Again, I am showing you always where you can go and get more information. And I'm I know enough to be able to share at a high level what you need to know. But if you go to the classroom and you go to asset class mastery, and then you literally go to structured notes. And as an example, Connie, I know you're part of the mastermind. You just go to the classroom and you can literally go to asset class mastery, and then you've got structured notes. Does that make sense? So you've got access to everything already, okay, in terms of that process. Okay, so that's enough on structured notes, unless there's something that anyone wants to ask. It is something that I like it as an investment, but it does scare me a little bit because I don't fully understand it. And again, it comes back to me being able to rely on my partners. A good example at the moment, we're in a structured note where 3 of the 4 stocks are really working, but PayPal has not hit its threshold. So we have what's called an income protector. So the income keeps being rolled over, but it's not being paid out. And until PayPal goes above $87, we don't get paid. And so it's these little nuances that are become a little bit more tricky than, I don't know, commercial property. For me, you've got a building, you have a tenant, the tenant's paying you rent, it is what it is. Like, it's a little bit easier to understand in terms of the overall process. Okay, enough on structure notes. Anything else that anyone wants to know on structure notes before I move on? No, we're good? Okay, right, now we get into the juicy piece. IRR, cash on cash, yield, and IRR, cash on cash, and cap rate. So I'm going to write this down for you just so you got it. IRR, cash on cash, yield, and cap rate. Okay, so I'm going to try and give you a high-level overview. There is a YouTube video that Shane and I have done that you can go and rewatch this if you want to, in terms of the breakdown, just to be able to understand this better. But what I'm about to share with you is probably one of the most valuable lessons that I can teach you when it comes to investing. So the most powerful calculator or formula that you need to know when it comes to investing is IRR. It's called internal rate of return. And what internal rate of return is that it basically, and I don't want to confuse you, but it has 27 variables. So there's 27 different variables when it comes to internal rate of return. You don't need to know how to calculate the IRR. I just want to be very clear. I don't even know how to calculate the IRR. It's a super complicated formula. You don't need to know how to do that. There's enough bloody chat GPTs and AIs now that you don't even have to worry about that. Like, calculating the IRR is easy. But what's important is understanding what it's all about. And in simple terms, what the IRR does is it takes all the important components to an investment. So it takes time value of money. So how long is you in the investment? It takes how much money are you investing? It takes what is the income return that you're getting on this investment? It takes the capital growth. It takes inflation. It takes 27 different variables into account. And what it allows you to do is now compare an apple with an orange. So like, you can compare a structured note with a commercial property in America, or you can compare a commercial property in America with the stock market, or you can compare gold with Bitcoin. Because what it allows you to do is compare any different asset class, because it finally comes down to one number. And that number, and let me just show you here if I pull up my screen here, that number is the total return that you can get every single year when you invest. So again, if we go onto the platform here, you will notice that you've got the IRR here. So this is your total return per year. So even if it's a 5-year investment, this is the return that you get each and every year. And so you can compare this investment, this one, this one, this one. You can compare all the different investments with your IRR. Are you with me so far on IRR and why it's so important? Okay. The next one is cash on cash. Now, people say to me, yield. Okay, so let me explain to you yield. Okay. Yield is what is called a mom and pop calculation. It's an estate agent's calculation. So yield is where if you buy a property for £1 million, and if you earn £10,000 a month, that's going to be £120,000 a year. Are you with me? If you want me to, do you want me to do this on a spreadsheet for you? Anyway, so it's £120,000 a year, and it's over £1 million, so it's worth £1 million. Okay, so let me just, Ram says yes, so let me pull this up for you quickly. Okay, so I'm just going to share my screen. Guys, there's nothing fancy here. Okay, so you buy a property for $1 million. It doesn't matter what currency you want. Let's just use whatever currency you want. That's not $1 million. That's 100,000. Okay, I'll tell you what. I'm going to use a currency so that I can tell. Okay, your rent per month is 10,000. So times 12 is 120,000. You with me so far? So what an estate agent will do is they'll come along and they'll say that the yield is 12%. Okay, so a yield is a very simple calculation, and it tends to be used by mom and pop investors and estate agents because it's the gross return. So it's the gross rental return divided by the total price of the property. Now, whenever they advertise property, they'll always say, you can buy in wherever this is, London or New York, at a 12% return. And everyone gets quite excited. But 12% is irrelevant. It is irrelevant because you still have to take off the mortgage payments that you're going to make, the management, the maintenance, the rates and taxes, the voids, the vacancies, and everything in between. That's why I say it's a middle-class mom and pop way of investing. It's a retail way of investing because it's irrelevant. It actually doesn't matter. Like gross is irrelevant. What is important is what is put in your pocket. So, as an example, if we do cash on cash and we do this the same opportunity here, is that to buy this property, let's just hypothetically say that you put down a deposit of 100,000. Okay, you with me so far? And let's say that your net let's say your costs here are, I don't know, let's just hypothetically say, I'm just literally doing this hypothetically. Let's say that this, including your mortgage and everything else, is 108,000. So your net now is equal to that minus that. Okay, it's 12,000. So this property is making you $12,000 a year. Are you with me? Okay. Now it's interesting. I didn't plan these numbers like it is. But if you look at this, okay, the cash on cash, so that's yield. If you do cash on cash, the way this is calculated is you go, I'm getting 12,000 net, and I have $100,000 in the property, and I'm actually getting a 12% cash on cash. Okay, now what that means, and by the way, there's something wrong. My maths is fine, but the numbers aren't exactly right. But the point being is that it means you're getting a 12% return on your money. So you put $100,000 in, and you're getting paid net in your pocket $12,000 a year. Now, what's important, and the only thing that's important, is what is the income that's being put in your pocket. It doesn't matter what the gross return is. It's irrelevant. What's important is what's being put in your pocket. Okay, so it's called cash on cash. Okay, now it's quite interesting and it's quite scary. And Alan, I can see you just joined, so you'll enjoy this story. I was sitting with someone and they were head of Nedbank Private Wealth. They were the head of Nedbank Private Wealth, and they'd never heard of cash on cash before. And I was like, wow, okay. Because the two most important metrics you need to know are IRR, which is the total return, and then cash on cash, which is the income in your pocket. And you can see on a debt deal, it's exactly the same because there is no capital growth. So the only return is the income return. Whereas on this equity deal, you've got capital growth plus you've got income. So the income component is 9% cash on cash, and the IRR is 22.5%, which is the income plus the capital growth. Now, Connie, it's not quite ROI because ROI is a simple calculation where if I put in my $100,000 and I sell it one day for, I don't know, that becomes $300,000. The way ROI is calculated is it basically takes that and it divides it by that. And your ROI is a very simple, ROI and yield are like the same sort of thing. So yield is a middle-class way of calculating income, and an ROI is a middle-class way of calculating capital growth. Okay, because it doesn't take into account inflation and it doesn't take into account time value of money. Whereas IRR is the way to do it in terms of total return, and cash on cash is the way to do it in terms of income. And that's why on our platform, we only worry about those two metrics. What is the total return, IRR? How long are you invested for? And what is the cash on cash? They're the three most important metrics in investing.
But in the UK, we call it ROI, return on your investment. It's basically the net cash flow of your invested money.
Okay, so let's do a thing here. I'm going to go and ask my buddy. In the UK, they call it return on investment. Can you? So let's see. I love so the one thing I think, Connie, where you spot on, although we all speak English, it's astounding how they use different terminology in different countries. Like between England, Australia, America, South Africa, they've got 4 different words for the same thing when it comes to transferring a property. Transfer, settle, there's the exchange, all of them. Okay, so let's do this quickly here. So you can see here, ROI is straight line view, ignores when the gains arrive. So it doesn't take into account time value of money. Does that make sense? Okay. Cash on cash focuses on the income today, ignores capital growth and time value. So again, it's what am I getting paid every single month or every single year? And then IRR captures timing and assumes periodic reinvestment. So it basically takes into account all the different values of the money. By the way, I can put this in a document if you would like me to. How they differ in practice. This is actually quite a useful document. Yes, I love ChatGPT. How do they differ in practice? So I should actually do this with yield as well. Wait, hang on. Let's just do this. Please redo this document. So just imagine who would like me to put this on a document and share this with you all. I must admit, ChatGPT just never ceases to amaze me. Like, it's like, I mean, this document would take me about 3 weeks to put together. So I think this is the key here. So you see the time value of money. That's why IRR is so important. Because if you're investing in crypto and you're holding it for 3 months versus investing in a commercial property and you're holding it for 5 years, it's important to know that length of time in terms of that process. And ROI, like I said to you, is more of a, like, effectively a middle class investment where it's just, you just work out the total gain and divide it by the number of years. Includes capital gains, so ROI yes, IRR, whereas cash on cash and yield no. Reflects leverage partially, and this one's yes, and this one's yes. Yield no, you see it doesn't take into account the mortgage. Simple and fast to calculate. You can see there, this one's hard. And used in UK buy to let. You can see less common, yield very common. I mean, do you see what I just said there? Like, this is literally the mom and pop way of investing. Where is this used? Property brochures and agent marketing. I think that probably says enough. Full project comparisons with exits. Yeah, I'll share this with you. There's no point in me trying to read through it all. I'll just read this today. But let's just look at the key takeaway here, which I think is key. To fully understand an investment, yield tells you how your income compares to price. Cash on cash shows you how efficiently your cash is working. ROI gives you a simple overall result. And IRR tells the real story, especially when timing and exit matters. Pro tip, smart investors don't rely on one metric. They triangulate between all four for a complete risk-adjusted picture. Does this help? Does it make sense? Yeah. Can you see why, for me, and I'm not saying we're right, but we made a decision to not dumb it down and to kind of do property brochures and estate agent marketing and use things like yield. I mean, we did actually consider literally calling this capital growth and calling this income, because everyone knows what that is. And then we were like, but then if we do that, we're not actually helping people become better investors. Again, if we want to empower everybody to invest like the top 1%, we need to teach you how the metrics work and what they are, so that you can actually, look at these different investments and say, right, does this one make sense, or this one makes sense, or whatever, based on the different results. So what I'd like to do is let me figure out how to do this. So if I go here, I'm going to stop sharing. I'm going to tell you what I'm going to do. I'm going to make this thing a lot more pretty, but let me see if I do a quick copy and paste onto a Word doc so that I can just share it with you now. No, that didn't really work. If I share this, okay. So if I put this in the chat room, just tell me if you click on this, if it works for you. Because what I want to do is I want to break up into breakout rooms. There's not that many of us in here, so I'm going to break us into 5 rooms, and then we can just go and discuss this in a little bit more detail. So I'm just going to sit down so I can get this thing sorted. So, okay, so Connie's got it. What I'll do is I'll leave it on my screen if that helps. I think I can do that. So I want to do this one, the key difference explained. And I want everyone to discuss structured notes, what we discussed today. And then also I want everyone to just go through IRR, yield, etc., if it makes sense. Okay, let me break us into the rooms. So open all the rooms. Let's go there for 10 minutes or so.
Scott, what's that thing you always talk about with Calio? Is it an AME or something?
ALM,
ALM.
asset
I don't know.
liability modeling. It's a fancy name for a wealth plan.
Okay. Because I brought it up to Connie and then she asked more and I was like, so, okay, thanks.
That's this thing here, Connie. I mean, you're a mastermind member, so you're going to get this here. Let me show you quickly. Um, So, sorry, Connie just asked a question, so I'm just answering that for her. So, step 5 is portfolio optimization, and that's where they go in and they look at your individual circumstances, they look at your Enneagram profile, and then the question you just asked Kelly is the ALM, asset liability model, and this all comes together with your portfolio construction. So, it's an entire plan, personalized plan for you, based on your own personal circumstances in terms of getting the results. So, yeah. Great. Okay, what's the feedback like? What was it like? Where did you get to? Just by the way, I want to show you how cool the world is now. While you were all chatting, we now have a document on understanding the investment language and everything else. I mean, it's not, I haven't quite finished formatting it yet, but it's all done. So I will finish that after the session and I'll share it with everyone. So yeah, never fails to amaze me, old ChatGPT. Cool. So what was it like? Give us some feedback, please. Type in the chat box, talk, do whatever you want. I'd love to. So Tabby said, lovely meeting the two gentlemen. Rose said, I couldn't join Breakout today. My dog has been ill. No problem. Did you like this, by the way? I mean, I can talk all the time. But is it worth getting in a room and chatting to other people and engaging? Yep, I can see Connie's shaking her head, saying yes. I don't know if anyone else. I'm looking at a. Anyway, okay. I never know. Obviously, for me, I'm always wanting to share and add value, but actually, I think there's so much time. I learned this from Roger Hamilton originally, where you take the time out and you have that personal contact, and you're able to discuss things and think about it and talk about it. It makes a big difference, Any questions that came up? So Kevin said I was struggling with my microphone. Okay. So Derek said it was good to make personal contact. Nirvana said yes. Great to chat with fellow investors. Yes, I enjoyed it. Yes, learning from one another. I was struggling with my microphone. It does. Okay, cool. Okay. So in terms of wrapping up today's session, I think really if we look at it from what were we trying to achieve today? And so today we were trying to go into like the where and the what. Okay, so where do we want to invest in the world? And I showed you the difference in terms of some of the different country metrics, the different city metrics, and the fundamentals of how you look at it. Now, you've always got two choices in life. The one is you can go and do this all yourself. And that's when I did the whole Wealth Going Global training. I said, look, like I can teach you how to do this, and you can go do it all yourself. I'll even give you all the links to go and do it all yourself. Or you can kind of partner with people that are already doing it. So someone like a Gary, have an understanding of like what is happening, and you don't actually have to go and figure it out and do it all yourself. Does that make sense? Like from an overwhelm perspective, you can kind of like, you can be sitting here going, holy cow, like look at all the stuff Scott's shared with me and where the hell am I going to be able to start? Or you can have the confidence to go, cool, I kind of understand what's important. But now if I can find the partners that are already doing that, then I don't have to do all the work myself. Does that make sense? And that for me is what I was trying to share with you today. So I started off today with like going deep or deepish. I can go a lot deeper, as you can see, but into like, where are the countries? What are the different countries you should look at? What are the different currencies? We went through the different assets, and why some assets and why not some assets. I even went through the 8 golden rules as to why we don't invest in certain markets or certain assets. And then I specifically chose to pivot into Gary so that you could literally have a real life example. So because we're always trying to move away from theory into practice, so that it's like, right, you've learned the stuff, what's the practical, how can we implement it? And then obviously with Gary, it's like learning the difference between being a mom and pop investor versus being investing like a top 1% or an institutional investor. And that was really the essence of what today is all about. Now, tomorrow, we now pivot into the asset classes and more importantly, how you allocate your portfolio based on the different asset classes. And what I'm going to do is this is where I'll start introducing the family office. I'll start teaching you the 6 pillars to wealth and what they look at in terms of the core concepts when putting together a portfolio construction. I remind you, I shared this yesterday, 85% of your total return is going to come down at the age of 65 to your portfolio construction. And what's so important is that you actually, either know how to do it yourself or you have a partner that can help you do it for you and your family. So that's kind of the essence of what we've been through today in terms of that process. I just want to see, Bram said partnerships are key, partnerships are empowering. Kevin says, now his mic decided to work. It's all good. If it makes you feel better, Kevin, I have this brand new fancy camera and screens and everything. They installed it like for about 3 hours yesterday. And when I got you at 8 o'clock this morning and switched my camera on, nothing would work. Nothing. Like I was like, I'm live in an hour. I'm like, you better come fix this shit and make it work. So anyway, it was a stressful start to the morning. But anyway, everything seems to be working. So yeah, I mean, any other questions for today? And then, for me, in terms of the VIP session, we've kind of rolled it up with talking about structured notes just to kind of give you better insight into that. And then specifically, I loved kind of the question that Connie asked around a yield, and it's actually kind of forced us to build this little document, which I think will be very valuable for people as a cheat sheet in terms of the difference between ROI, cash on cash, IRR, and yield. And I'll finish it up. I've nearly finished formatting it, but I'll format it up and then I'll put it in the VIP group so that you guys can take a look at it and let me know what you think. But yeah, it's I think this is probably, I don't actually know anymore if this is our 8th, 9th, 10th challenge. I don't actually know how many times we've done it, but I've never had a document that explained it like that. So it shows you how technology is improving and making life so much easier. Because normally I just try and explain it and I do it on a board and I do my spreadsheets like I tried to show you. But actually that's so brilliant with like tick boxes and green ticks and red ticks and everything else. So my question to all of you to finish off today, what is going to be your commitment today? Let's, this VIP thing is mainly about getting results. And so what is one commitment you're going to make to yourself? You can either share it in the chat room or you can just write it down. But I'd like you to kind of make one commitment in terms of what we've been through today. Because, yesterday we explained why diversification. Today we started to get into the nuts and bolts of where to diversify and what to diversify in. And my question is, what is your commitment to what you're going to do for yourself? A good example would be, we've got the Payday Accelerator, and that literally just helps you get started. It's 30 days in terms of being able to get results and ultimately, get your first payday. Now, whether your first payday is $1 or $1 million, it doesn't matter, but it's about getting started and getting results. So we gave you that link to be able to get started. You can do it for free if you want to. But statistically, according to our own research, 2.32% of people will finish. And so we went, that's not good enough. So we now actually have Alex. We paid a lot of money for Alex to become a qualified, certified international coach. And he guides people through the process to be able to assist them in terms of it. So Bram said, appreciate what you do, especially the practicality. Oh, thanks, Bram. Look, that's the whole purpose of these VIP sessions, is to be practical. So, we can teach theory all day long, but there's no point. I prefer when people are asking questions. I've always said this, I much prefer the VIP sessions than the presenting part, because quite frankly, anyone can present. And nowadays with ChatGPT, I don't understand why you even need me to present. It's all there, the information. Derek said, apply what we learned to assist in achieving the results. So fantastic. Kevin said, I commit to learning one new thing about creating passive income every day. Brilliant. Is paid on the mastermind school. Nirvana, I'm not sure actually, in terms of that process. So, but yeah, if you want to, just reach out to Alex and he'll be able to support you with that, in terms of that process. Bram said do his homework. So that's brilliant. So yeah, my only strong recommendation to all of you is that's why we say do the silver homework, and you don't have to do the gold now, but you should do the silver. And we very intentionally, when Shane and I set this up, we intentionally have it as like a 15 to 20 minute kind of homework period. That's kind of what we're looking at. Thomas, slowly and surely increasing my passive income $1 at a time. So brilliant, Thomas. In terms of that process, I do love Zig Ziglar's principle. You can have anything you want in life if you help enough other people get what they want. So that's why we have presenting and teaching. Nirvana, do the homework. So brilliant. Cool. So my commitment will be to get that document finished and to get it over to you guys on the VIP for all of you. I might or might not share that with everyone else, but it'll certainly be for your domain. And it's one of the things I really enjoy about these sessions. Ellen asked a question 2 weeks ago about how to create a portfolio, and we ended up building a document out of that. Today it was IRR and yield, and it's awesome because without knowing what people are looking to answer, I battle to help in terms of that process. So yeah. But I think that's probably enough for today. We've probably fried everyone's brain. I'm about to kill my dog because it's barking at the gate. I don't know if you can hear it at the door. But anyway, and otherwise we'll see you tomorrow. So reminding you that tomorrow is each day actually builds upon each other, and tomorrow gets even more important. And I think, Connie, you and I are seeing each other in 36 minutes. So have a toilet break, get some lunch, and I'll see you for our one-to-one session. So in terms of that process. And to the rest of you, we'll see you bright and early tomorrow morning or whatever time zone you're in. And please make sure that you live up to your commitments. Have a good day. Cheers.